Good morning, ladies and gentlemen. On behalf of Mongolian Mining Corporation, we would like to welcome you all to attend the company's 2012 annual results announcement investor presentation. It's my pleasure to introduce you to the senior executives from the company. Dr. Botsenkov, Executive Director and Chief Executive Officer. Ms. Ingzaiman Namdoji, Executive Vice President and Chief Financial Officer. Ms. Yulemji Baksu, Executive Vice President and Chief Investment Officer. Mr. Samuel Bowles, Executive Vice President and Chief Operational Officer. Now I'd like to invite Dr. Bot to do the presentation. Dr. Bot, please.
Thank you. Good morning, ladies and gentlemen, and thank you for coming and expressing interest in Mongolian mining operations and annual results of 2012. Yesterday, March 11th, Board of Mongolian Mining Corporation has reviewed audited financial and operational results of 2012 and approved. So our results and announcement was released today morning 6 a.m. at Hong Kong Stock Exchange and company websites. And please allow me to share the major highlights and operational data for 2012. Also share certain views for outlook in 2013. As usual, forward-looking statements. And we will start with operating environment, looking at Mongolia, our home country and operating country. In 2012, if you look at major macroeconomics data, for example, in GDP, you can see what mining is still representing almost 20% of total GDP and is still major driver of economic growth, which went to around 12-13% year on year. In terms of exports, minerals still representing almost 90% of total Mongolian exports, and within these commodities, coal with 48% still represent very big portion. So it shows the importance of coal sector in economy of Mongolia. Looking at some regulatory updates, I believe 2012 major regulatory updates are related, of course, to foreign investment regulations law, which was passed by Mongolian Parliament and become effective on 17th of May 2012. Obviously, I believe it was quite widely described in media. And the major points are what government approvals, regulatory approvals would be required for any foreign investments in sectors like mining, banking, media, and communication. In terms of company, as majority owned, Mongolian Mining Company, we don't see any impact on operations of MMC direct, because law does not obviously apply retrospectively. In terms of environmental regulation, Parliament, again in May 2012, passed some amendments in terms of on utilization of environmental resources, which of course covers such resources like water, which is essential for our operations. And according to this law, some increase in charges for water to be used by mining companies would be applied. But in our case, because we've been already implementing environmentally friendly technologies in terms of our wash plant operations, looking at over 94% water reutilization rates, and also power plant operations, looking at air-cooled system. Obviously, water usage was already designed to be minimum, so the direct impacts on our operating cost, we estimate, would be also marginal. The next important update is related to double taxation agreements, which being at current stage unilaterally terminated by Mongolian parliament in relation to some countries like Luxembourg, Netherlands, United Arab Emirates, and Kuwait. And it's not current implication to company operations, but in future for potential dividends, because company intermediary holdco is based in Luxembourg. If current structure will remain in place, certain withholding taxation on dividends would be applied. So we will assess the situation, and obviously we will update shareholders in due course about potential implications and company actions in this regards. In terms of excise and custom taxes, the government has authority under the law to set the custom tariffs and excise taxes for fuel. And starting from end of November 2012, the custom taxes and excise taxes on oil products being zero in order to maintain the low rates in Mongolia, given the external price increase. Government decided for wholesale, which includes also mining companies, the 3% custom tax should apply, and also one-time excise tax equivalent to 109,000 Mongolian tugruks, which is around $70-80 per ton of fuel, will be charged. If you calculate the overall impact on fuel price, it's around 5% increase. In terms of total mining cost, is around 1% implication. So we see it's again marginal, minimal impacts on operating costs. In terms of coking coal exports from Mongolia, obviously major market remains China, and we still, despite all turbulences which we face in 2012, believe, according to research reports, what the steel production will continue to grow in midterm, and obviously subsequently the coking coal consumption will continue to increase, although maybe it's at moderate rates compared to what we experienced in last 10-15 years. And moreover, Mongolia is becoming the major coking coal exporter to China, and is expected to keep this position given the competitive advantage driven by geographical proximity and increasing demand from China. If you look at statistical data on Sino-Mongolian coal trade dynamics, you can see what the Mongolian exports grew steadily from 2009 to 2011. In 2012, it was around 20.9 million ton, including lignite exports. And MMC share in total Mongolian exports of coal in terms of volume increased from 23% to approximately 27%. And I need to note what this volume increase is also notable given the fact what 2012 we shifted more to washed coal sales. So in terms of volume, obviously, it was decreasing because of, obviously, after protesting, you have lower volumes, but we've still been able to increase our share and outperform our Mongolian peers. In terms of Mongolian volume share in total coking coal imports, Chinese imports, as it's reported by statistical data, in 2012, it was almost 36%. It still declined compared to 46%, but Mongolia still preserved its position as a number one supplier of coking coal to Chinese market, ahead of Australia. In 2012, China imported in total almost 54 million ton of coking coal, and as said, more than 1/3 was coming from Mongolia. Let's move to business review. Obviously, company operates 2 coking coal mines, both located in South Gobi region. in close proximity to each other. It's around 30-kilometer distance between UHG and BN mines. If we look at pro forma resource and reserve base, based on latest JORC-compliant resource and reserve reports, available combined resources, pro forma resources at BN and UHG mines, it's more than 980 million ton. The increase we reported in our interim report on UHG resources around 120 million ton based on our last 3 years exploration results, which represents more than 20% increase in JORC-compliant resource base at UHG deposit. And moreover, increase of coking coal proportion from 57% to 68%. In terms of reserves, combined reserve base, pro forma base, it's around 460 million ton, and we are in process of updating our life of mine studies for UHG, reflecting the recent changes and geological base, and also combining both mining operations. We will have updated reports shared with public, I believe, within first half year of this year. Looking at mine production, we continued mine production volume ramp up, looking at large-scale open pit coking coal mining operations. Total combined run-of-mine ROM coal output reached 9.4 million, which represents more than 32% increase year-on-year basis, with stripping ratio of 5.6 BCM per ROM ton mined. At UHG mine, we reached around 8.6 million ton, and 0.8 million ton was derived from BN mine, which started commercial operations in February 2012 after our acquisition completion in June 2011. On mining side, we continue to focus on improving our operational efficiencies, reliabilities, and obviously focusing on safety. In terms of mining specific tasks, from second half, we started focus on stockpile management with lowering the ROM coal inventory levels and targeting the direct dump to CHPP, reducing the coal rehandling requirements, and we will continue with these efforts in 2013. The lost time injury frequency rate was reported 0.72 for full year of 2012, which is very favorable compared to any our industry benchmark results. Conducted almost 100,000 man-hours of safety training involving group staff, employees, contractors, and visitors. So we solidified our position as the largest coal mining operations in Mongolia with highest safety standards meeting the industry international benchmarks. Looking at wash plant operations, CHPP capacity expansion continued, and currently we run at 10 million ton per annum nameplate processing in feed coal capacity. So Model 2 fully operational from second half of 2012, as a result increasing combined processing capacity to 10 million ton. In 2011, we processed 7.4 million ton of run-of-mine coal, which represents almost 200% increase compared to 2011. The production increased to 5.5 million ton compared to 2011 numbers. Total product the construction for CHPP Model 3 is virtually completed by year end, and we will start commissioning process in second quarter and aim to put in operation starting from second half of 2013, bringing combined processing capacity to 15 million ton, targeted projected capacity starting from second half of 2013. Wash plant has fully available and operational complete infrastructure. in terms of power and water supply. Models 1 and 2 operated 5,500 and 3,500 hours in 2012, respectively. So averaging in total feed rate 800 or around 830 tons per operating hour. Obviously, we already operate second winter, so we demonstrated it's possible to operate wash plants in winter conditions all year round without any significant impact at operational throughput. Proportion of electricity consumption in 2012 supplied by our power plant was almost 90%, representing substantial increase compared to only 34% in 2011 because power plant became operational only in October 2011. So obviously it's resulted in lowering our power unit costs, and also it results in lowering the unit cost of processing. In terms of water consumption, the tailing disposal return water increased. So it's also again represent the lowering the unit freshly extracted water consumption, increasing our return rates to levels of 94% combined. So it's again represents significant cost savings and will represent significant cost savings in future in light of increasing environmental charges for water utilization for mining industry. If you look at our mining output, obviously at semi-annual basis, you can see combined output, Rom-ton basis, UHT and Baronaran mines, 2.5 million in first half of 2011, in second half of 2011, 4.6, 4.1 in 2012 first half, and going to 5.3 million semi-annual tonnage in second half of 2012. So we're running again at roughly 10 million ton run of mine production rate, which is matching our processing capacity. So this equilibrium will be held because with shifting towards wash coal sales, obviously the mining is not the major driver of our operations. Now the wash plant operations become the rate determining function in our operations. So how much we can process, how much we can produce wash coal will determine our sales to our customers. So mine output needs to be adjusted to CHPP output. Once we've been selling raw coal, obviously what is mined was sold, right? But now it's going through CHPP. In terms of stripping ratio, you can see the seasonality. In first half year, obviously mining is more focused on pre-stripping activities and increasing raw coal output in second half. Obviously, it's given by factor what first quarter of every year usually it's quite slow, given the seasonal holidays like Chinese Lunar New Year and so on. So obviously, the mining activity is also synchronized with this seasonality in demand from customers. In terms of coal processing, the total product output, obviously, we started mostly in second half of 2011, total product output around 1.9 million ton, around 2.1 million ton in second half of 11 and first half of 2012 respectively, increased to 3.4 million in second half of 2012. In terms of transportation and logistic operations, so we utilize truck and road mode. And obviously after completion of our paved road, which became operational in October 2011, in 2012, full year around, we enjoyed the increased capacity and safety metrics in terms of transportation activities. So comparably, in 2012, more than 70% of total tonnage from mine to TKH with Mongolian side of border, custom clearance stockpile, was performed by our own fleet compared to, I believe, around 23% in 2011. So it's quite substantial increase given by our increased trucking capacity by adding 300 double trailers in late 2011 and early 2012. It also helps us reduce the transportation costs on long haul. Obviously, contractor charges higher compared to our own operating costs. We will continue with this trend in 2013 and aim to increase again our proportion of our own fleet on Mongolian side of transportation between UHG and TKH border crossing. Again, implementing the double trailer trucks and utilizing the paved road increased the trucks turnaround and also unit productivity, also resulted in fuel savings around 27%, maintenance cost reduction around 18%, which all results in significant reduction on transportation costs on UHG TKH section, which was around $9 per ton on long haul section, compared to 19 in 2011 when we're using mostly the gravel road. So you can see the quite dramatic cost savings. 2012, we experienced some increase on cross-border transportation. Obviously, given the competition for contractor trucking transportation fleets, and we are aiming to focus on lowering this cost in 2013. Moreover, in 2012, we completed the road works between Baron Naran and UHG mine. So we currently have fully integrated transportation infrastructure, paved road connection from BN mine to UHG and from UHG to Kashan-Sokhart border crossing for our imports to China. Looking at target market, which is shadowed by this brown color, obviously we have sustained our customer base and added the customers like Jigang, located in Shandong province. In November 2012, we signed 5-year cooperation agreement and also signed a cooperation agreement in May with Datang, which is one of the largest power producers in China. What is notable is obviously the, as expected, dramatic shift towards washed coal sales. And if you look at data in 2011, washed coking coal sales represent around 32% in terms of total sales volume in 2011, around 1.5 million ton, increased to 3.6 million, which represents almost 2/3 of total sales volume in 2012. And raw coal sales been reported less than 400,000 ton, and mostly, of course, in first half of 2012. We continue with our strong commitment to socially responsible operations and safety metrics and environmental protection metrics. So we contribute to township development and raising standards of living for our employees and also the local residents in communities where we operate. And by early this year, around 300 families of our employees and also some residents moved to new apartment blocks. And also school and kindergarten complex construction was completed in 2011 and commissioned early 2013. So providing the secondary education facilities not only for children of our employees but also for local residents. And it's all together, of course, it's related to community development, but it's also important for company because we maintain our competitive stage as an employer and keeping skilled and talented workforce compared to any of our competitors in Mongolia. And also, same time, it helps us to build up local support and get so-called social license for conducting our operations in communities where we operate. In terms of environmental protection, obviously one of the major activities was the cultivating forest belt in desert conditions, covering more than 10 hectares. It's around 13,000 trees are planted with support of local community, and we believe it will also again contribute to maintaining the eco-balance in mining area. Looking at railway project, obviously it was again one of the major highlights, and in May 2012 we signed build operate transfer agreement with Mongolian government for 19 years, and we started the railway construction works in June. In November, early November 2012, government of Mongolia, recognizing the importance of railway development, decided to conduct unified railway project, combining all railway development projects, not only our project, but some projects going from Titi area to Sanshan, from Sanshan to Choibalsan, and so on, to one project, which will be funded and managed by government sources. So, also based on decision of government, it's aimed to allow project continuity, so no delays should be experienced, recognizing the importance of this railway project for Mongolian economy. And all previous concessionaires, including MMC, have been invited to have the option to participate in project development. Current status, we obviously after government decision started dialogue with relevant government agencies and government entities. So major step would be determine the costs which incur to company to date of government decision. And based on government decision and confirmation of these costs, it could be converted to our share in joint railway project. So currently the negotiations with government and discussion is continuing, but we expect to be completed within first half of 2013, and we will update public in our shareholders as soon it will be available. By company accounts, it's around total costs incurred in executing this railway project since inception in 2008. In our company books, it was around 62.4 million. And obviously, we will be looking at recovering these costs, either in convert to participation in a joint railway project. Let's look at financials. Obviously, you can see the semi-annual sales tonnages, and again, you see the seasonality between first half year and second half year. In 2011, 1.4 million total coal sales compared to 3.4 million reported in second half of 2011. Similar picture in first half of 2012, 2.4 million ton compared to 3.2 million ton in 2012 second half. In terms of ASP and sales volume for washed hard coking coal, obviously you can see again similar seasonalities, although we have increased tonnage compared to 2011. Sorry, it should be 2011. And what is more important, continuing economic global conditions and obviously impacting the seaborne prices and also Chinese domestic coking coal prices. You can see the trend. First quarter, sorry, it's correct, it's quarterly, sorry. So it's first quarter 2012, 152, which is more or less in line with our full year ASP reported for washed hard coking coal, around 155, 56 in 2011. Dropping moderately to 133 in quarter two, and we see the dramatic or rapid change to around $94 in quarter three. Although the price is stabilized in course of quarter four, and we start see the gradual recovery in these prices. So this decrease in selling prices for hard coking coal, which is obviously a major driver of revenue and profit for company, resulted in revenue change to 475 million approximately compared to 540 million reported in previous year, and also change in adjusted EBITDA by around 100 million, going to 66 million for 2012 compared to 169.9 in 2011. In terms of external factors, obviously company have to follow the market prices, but in terms of internal factors, we continued our focus on maintaining and lowering our operating costs. So if you look at mining cost at ROM ton basis, it was reported 19.8 in 2011, going down by almost 16% to 16.7 in 2012. Obviously, one of the contributors to this decrease was the VAT rebates, because obviously shifting to more washed coal sales compared to raw coal sales, company is in position to apply for VAT rebates, and VAT is 10% in Mongolia. I believe the VAT component in terms of cost saving was almost $1.7 per ROM ton, so it's quite significant. In terms of processing cost calculated per ROM ton feed, it was reported $9.1 in 2011, and 6.2 is cash cost, which is consumables, power, water, and staff cost, contractor costs, and so on, and 2.9 in amortization and depreciation. It's decreased by almost 20% to 7.3 total processing cost per ROM ton basis. So we saw significant reduction in cash costs, and it's mostly attributable, as I mentioned earlier already, in reduction in power costs, I believe more than $1. Also the increasing efficiency and economy of scales, because increasing the capacity. And we will believe what we will see the further increase once we increase our capacity, processing capacity in 2015. In terms of transportation costs, total combined transportation costs for our transportation to Ganjmodo decreased by around 6.4% from 23.4 in 2011 to 21.9 in 2012. And again, the long haul section, which is on Mongolian side, from mine to TKH, on stockpile on Mongolian side of borders, decreased from 17.2 to 11.9. 11.9 is combination of 70% our own trucking and around 30% done by contractors, right? So this was quite good achievement, and it's of course thanks to implementing that double trailer trucks and also paved road operations, reducing fuel cost, maintenance cost, increasing efficiency. But what we saw the cross-border short-haul transportation from TKH to Ganjmodo increased from 6.2 to 10. Currently, it's at the level of around $8 compared to $10, which was reported for 2012. And we will continue to focus on reducing this section, because we believe this is still big possibility to reduce overall transportation cost by focusing now on this short-haul transportation. Because in terms of long-haul transportation costs, I believe we did what was possible to improve, and now we need to focus on this cross-border transportation. But it's not fully depending only on company, so it also depends on outcomes of dialogue with Mongolian and Chinese authorities to improve the efficiency of cross-border transportation in terms of regulatory and approvals from both sides. For example, working permits and visa for Chinese drivers to enter Mongolia, smoothen the cross-border, and so on and so on. So we engaged in this dialogue, but we'll see what will be outcomes in 2015. In terms of total operating cash costs, delivered cost to Ganjmodo, if you look at year-on-year basis, we reported around $78 compared to 81, which was reported in 2011 for washed hard coking coal. And this includes mining costs, processing, handling costs, transportation, logistics, site administration, inventory losses, royalties and taxes, and fees paid at cost of goods level. Looking at balance sheet and liquidity, total assets grew to almost 2.2 billion, and equity represents book value of equity around $752 million US. In terms of trade receivables from our customers, you can see in 2011 it was around $41 million US. We've been able to decrease it to lower than 36 million, despite the challenging environment for coal markets in 2012. And also, if you look as a percentage of total your annual revenue, we maintained this level below 8%. And I believe it's quite good achievement in current market environment. In terms of current liabilities, we also saw the decrease from 550 million to 420 million. It's again connected with the leveraging process we're repaying, and also refinancing activities, providing the financing facilities with longer maturity and lowering the current liabilities. And current ratio increased from 0.5 to 1.4 year-on-year basis. In terms of net debt, obviously it's increased from 330 million to 725 million. And net gearing ratio increased from around 20% to 33%. And it's obviously driven by issuance of senior secured notes in March, 600 million. And we believe it was appropriate action to maintain the liquidity position and look at proper finance structure. And even at gross gearing ratio, I think as a percentage of gross debt to total assets, it's still around 46%, which is below the 50% target, which was set as an internal target by management team. And also, I think I will focus on some one-off items which incurred in 2012 and resulting in reported marginal but still lost $2.5 million US. And if you go by major items, $2.3 million US was contribution from net interest expenses, which we started putting under our P&L in financing cost instead of capitalizing, which was related to railway project funding. After decision of government was issued in November, for November and December, the accounting treatment of these interests for funding proportion, which was related to railway project, obviously instead of capitalizing, we put in our P&L financing cost. Also with railway decision, it was certain deferred taxes booked, and we've been expecting to take these benefits in future once railway become operational, and obviously with projects sponsorship and ownership moving to government hands, obviously company will be not in position to do this, so it's contribution 2.8 million. Around 5.9 million is allowance for doubtful debts, and given the current market situation, we don't face any major issues with our credits we issue sometimes to our customers to maintain certain competitiveness among the customers. But just to be proper, we put under our credit policy, obviously we are building up provisions, and we build up for 2012 provisions $5.9 million. In terms of inventory losses, it was around 19.5 million. And the major drivers of inventory losses, obviously, it's increased cost of inventory because you start selling more washed coal. Obviously, the unit cost of inventory is increasing. And also, some inventory losses, I need to point out, it's unrealized nature, because once you have million or 2 million stockpile, obviously you derive your measurements on volume and density assumptions and so on. So until this stockpile is cleared and measured how much it was through weight breaches or something like this, it's quite difficult to say really how much is sitting there. And obviously with some changes in geometry and volume measurements. Obviously, we have to report it as a changes in inventory, but the realized nature will become only once the stockpiles are cleared. So we believe it's a proper treatment, and comparably, just to mention, I believe last year, for example, we reported 2 million inventory gain for Romco, right? Because volume was actually bigger as we've been expecting. This year, volume is lower as we've been expecting. So I think these movements will continue, and we'll continue building provisions to reflect these changes. And in terms of all these items, if you combine, it's around more than $30 million, which are accounting treatment of one-off items. Also, in terms of inventory losses, I would just add, obviously, once your profitability and prices are higher, as a percentage reflection would be lower. But once you are going to close to break-even level, these kind of items are obviously popping out. In previous hour reportings, it was not highlighted separately because it was under each mining or transportation or processing or whatever cost of goods under these items. But because of this year reporting requirements, in order to provide full picture and bigger, more detailed picture to our investors, we highlighted this issue and showing us a separate item. In terms of percentage of total revenue, I believe it represents around 4%, and I still believe it's within industry norms. If you look at capital expenditures, historical, in 2009 and 2012, you can see what obviously our capital expenditures, according to our original plans, are culminated in due of 2010, 11, and 12. Going forward in 2013, we expect around 50 million capex, which is associated with completion of water supply facility expansion and finishing the CHPP number 3. Some deferred payments from last year and so on. And this would be majority of capex already spent. And in terms of coming back to liquidity management, with capital expenses culminated, obviously management will look at gradual deleveraging as in future. Just to wrap up some major highlights and milestones, in January, just to remind you, we completed and commissioned the border expansion together with Erdenes MGL on Kashusuhat, so increasing border crossing capacity to almost 30 million ton estimated, compared to 10 million which was previous, by adding 8 more border crossing lines for trucks. In February, we successfully commissioned by government authorities Model 2 of CHPP, and also Baronaran mining operations get approvals from government commission. So we started commercial production at our second mine, and total production output was 0.8 million ton in 2012 at Baronaran mine. In March 2012, we issued 600 million 5-year senior notes. At that time, it was rated B1, B+ by Moody's and S&P. It was largest corporate bond from Mongolia, and first to be issued under 144A regulations from the country. Also, in March, we completed the delivery of our hard coking coal under FOB Nakhotka terms to Indian customers and also China Steel Taiwanese customer. So taping the test shipments to seaborne market to Russian route. Also, we completed the agreement with Standard Bank on 200 million facility agreement on financing. Also in March, we amended the loan agreement with EBRD FMO in DAG, which was issued at our operating entity in Drone in 2010, and we've been able to release the mining license share, mining license pledge, and also share pledge, and also margins been reduced by in range of 150 to 310 basic points. And in terms of company stocks being selected as constituent stock for FTSE index, Hong Kong index in March 2012. In April, obviously the efforts of company in terms of conducting socially responsible mining activities have been publicly recognized, and we've been selected as one of the finalists in Global CSR Summit in 2012 for excellence in corporate social responsibility. In May, we entered long-term agreement with Datang, one of the major Chinese power producers, to supply our middlings. And going forward in November, we issued promissory notes upon the completion of independent technical studies confirming the reserve numbers at Baronaran, and promissory notes total valued at 105 million according to SPA. Acquisition agreement was completed. Also, government in November, as I mentioned, decided on Unified Railway Network Development Project, taking over the funding obligations to develop this project. Also in November, we signed long-term cooperation agreement with Jigang, the subsidiary of Shandong Steel, expanding our end-user customer base. And in December, just for your information, our notes been selected and awarded by Afra Asia. Looking at outlook in 2013, in terms of mining, we will be targeting 12 million ton of run-of-mine coal production combined output in 2013. As I mentioned earlier, we will be finalizing the life of mine studies and reserve raise estimation works at UHG and BN mines within Q2 of 2013. Also, we'll be realigning our cooperation with our mining contractor Leighton operating a UHG mine, and looking motivating Leighton based on company objectives in terms of washed coal delivery tonnages, and not only on specific mining targets in terms of overburden movement of raw coal output. So it will be continuation of our very good collaboration with our mining contractor. In terms of mining specific activities, in terms of cost savings, we're also looking at increasing the proportion of ANFO explosives to be used in our blasting operations, and as a cheaper alternative compared to emulsions, water-resistant emulsions, which are used previously, but they are higher cost. So obviously with some possibility room to reduce the blasting cost, which still represent quite substantial portion in mining cost. I believe it's around 10% of total mining cost. In terms of processing, obviously we will be matching our mine output and targeting to process 12 million ton of raw coal. I believe it's very achievable given the performance of our 2 wash plants in second half and expected commissioning of third wash plant in Model in second half of 2013. We expect around 6.5 million ton of washed hard coking coal production, marketable production, which will be moved to our customers in 2013. Also important in terms of water savings, we will complete the belt filter press installations in second half, which will again improve, I believe, already high water recycling and reduce potential impact on water environmental charges increase. And important thing, we will be focusing on optimizing coal blending to maximize coking coal output, which is a complex task given the multiple seam nature of UHG, and also we are adding the Barunaran mine output on this. In terms of site management, we will be looking also at operational expenditures reduction by moving more staff to operational locations. So we will be reducing the number of staff who fly in and fly out. So we have every 3 weeks or something like this, the flying costs from UB to site operation location. And with this accommodation facilities, this is also intention of company to support the moving employees to workspace location with families. And also we will change roster schedules, which will reflect the safety measurements. Currently we have roster schedules 14/7, 7 days night shift, 7 days day shift, 7 day off. Now we will go to 8/4 arrangements, so 4-day night shift, 4-day day shift, 4-day day off. So the time personnel working at night shifts will be reduced from 7 to 4, which will increase obviously the safety metrics, which is understandable, but at the same time, change of overall roster schedules from 14/7 to 16/8 will result in decrease of fly-in, fly-out costs. We'll be looking at boosting our operational efficiency and productivity, obviously by sharing and amalgamating site-based support functions for UHG and Barunaran operations, and looking at synergistic development and operation management and sharing available resources, and also forward focus on reducing operational costs, focusing to avoid the indirect costs like rehandling costs. So we'll be focusing on reducing the inventory, ROM coal inventory levels, and shift more to in-pit inventory levels. So coal will be overburden removed, exposed, and will be available to be mined directly and used to CHPP, which reduces the need for double handling, moving coal from mine to ROM stockpile, and again from the ROM stockpile to wash plant. In terms of 2013, I will share with you the operational updates, of course, based on unaudited management accounts and company information as of February 28, so first 2 months of operations. Total mining, first ROM coal, it's around 1.3 million ton, and CHPP washed around 1.8 million ton, with total product yield comparable to 2011, around 71%. And again, almost 100% of total transportation at first 2 months was conducted by our own trucking fleet. And this year we are targeting to increase this proportion from 70 to 80%, again lowering our blended transportation cost on long haul section. In terms of coal sales, in January, sales volume reached almost 690,000 tons, and of which almost 520 kiloton was washed hard coking coal. In February, sales surprisingly remain strong despite the Chinese Lunar New Year. It's around 500,000 ton, of which 270,000 ton was, according to company data, hard coking coal. So the start of year in terms of volume movements compared to all our historical previously reported numbers was much stronger. So, and it provides us believe what in terms of moving volumes and tonnages, company has all capacity and capability and customer appetite. And we've completed CAPEX and our robust production profile in 2013, we believe to well positioned to perform, and of course subject to market prices, how coking coal market prices will derive. Thank you for your attention.